August 5th, 1981. 13,000 air traffic controllers walk off the job. They want higher pay, shorter hours, better equipment. They are asking for what unions had asked for since the New Deal: negotiation, compromise, a seat at the table. 48 hours later, they are all fired, every single one. The President of the United States issues an ultimatum: return to work or lose your job. They don't return. He fires them. Ronald Reagan had been president for 7 months. That decision defined his presidency. It defined the next decade. It marked a transformation in how the American economy functioned, not because of what it said about unions, but because of what it revealed about Reagan's governing philosophy. Reagan didn't just change policies. He changed the operating system. An economy built on one set of assumptions was replaced with another. Production gave way to finance, labor to capital, regulation to deregulation, long-term stability to short-term growth. The question isn't whether Reagan was right or wrong. The question is what actually happened, what he did, why it worked politically, and what it set in motion. Because love him or hate him, Reagan rewired the American economy. And understanding that shift means understanding everything that followed. Here's the story of how he did it. 1980. Reagan inherits an economy in crisis. Stagflation. The word itself sounds contradictory. Stagnation and inflation at the same time. The economy isn't growing, but prices keep rising. Unemployment is above 7%. Inflation is in double digits. Interest rates climb toward 20%. The post-war consensus is breaking down. High taxes on the wealthy, strong unions, regulated markets, expansive government programs. That system had built the largest middle class in history. By 1980, it no longer seems to work. People are angry. They want change. Ronald Reagan offers a simple message. Government isn't the solution. Government is the problem. Cut taxes. Deregulate. Unleash the market. Trust capitalism to fix what government broke. He wins in a landslide. 489 electoral votes. He has a mandate. He has a plan. He has economists promising that supply-side economics will revive America. The plan is radical. Cut the top tax rate from 70% to 50%. Then cut it again to 28%. Cut corporate taxes. Deregulate finance. Weaken unions. Expand military spending. The theory is simple. Lower taxes will generate so much growth that revenues will rise. Deficits will shrink because the economy will boom. It's a gamble. The largest economic gamble in modern American history. Then come the air traffic controllers. August 1981. PATCO goes on strike, the Professional Air Traffic Controllers Organization. Federal employees, unionized. The strike is illegal. But similar laws had been ignored for decades. The government always negotiated, always compromised. Reagan doesn't. He fires them all. 11,000 workers. Gone. Banned from federal employment for life. He brings in military controllers, supervisors. The planes keep flying. The signal is unmistakable. The old rules are over. Labor has no leverage. Capital holds the cards. Companies notice. Within months, they begin breaking unions as well. Permanent replacement workers. Forced concessions. Unions that had built the American middle class are suddenly powerless. Membership collapses. In 1980, 1 in 5 American workers belonged to a union. By 1990, it's closer to 1 in 10. The mechanism that once forced companies to share profits with workers is gone. At the same time, the tax cuts arrive. 1981. The Economic Recovery Tax Act, the largest tax cut in American history. The top marginal rate falls from 70% to 50%. Capital gains taxes drop. Corporate taxes drop. The promise is universal benefit. Growth will lift all boats. The revenue never arrives. The deficit explodes. Reagan enters office with the national debt at roughly $900 billion. He leaves with $2.7 trillion. It triples. Every year the deficit grows. Growth was supposed to pay for the cuts. It doesn't. But the stock market responds immediately. Lower taxes on capital. Deregulated finance. Easier money. Wall Street booms. The Dow rises from under 1,000 in 1980 to nearly 2,700 by 1989. If you own assets, the Reagan years are extraordinary. Deregulation accelerates. Savings and loan institutions are given new freedom to invest. They take on risk with depositor money. Real estate speculation, junk bonds, leveraged buyouts. The guardrails built after the Great Depression are dismantled. Finance changes character. It's no longer about matching savers with borrowers. It's about extracting profit from capital itself. Corporate raiders buy companies with borrowed money, strip assets, fire workers, and sell the remains. It's legal. It's rewarded. Quote, "Greed is good." That line isn't satire. It comes from Wall Street, the defining business movie of the decade. Manufacturing follows the same logic. Production moves abroad, cheaper labor, fewer constraints. Reagan's trade policies encourage the shift. The Rust Belt begins to rust. Factories close across Ohio, Michigan, and Pennsylvania. Jobs move to Mexico, to Asia, to wherever labor is cheaper and unions weaker. And still, the headline numbers improve. GDP grows. The market rises. Reagan points to the data as proof of success. Morning in America, the shining city on a hill. Optimism returns. People feel prosperous. Then comes 1987. October 19th, Black Monday. The stock market falls 22% in a single day. The largest one-day crash in history. Larger than 1929. The financial system seizes up. Banks stop lending. Companies stop investing. The deregulated market, meant to discipline itself through competition, collapses under its own weight. The government intervenes. The Federal Reserve floods the system with liquidity. Interest rates fall. The crash doesn't turn into a depression. Markets recover. But a pattern is set. Deregulation produces instability. Government steps in to stabilize the system, and once the crisis passes, deregulation resumes. The next failure follows quickly, the savings and loan crisis. Late 1980s into the early 1990s. More than 1,000 savings and loan institutions collapse. They had been deregulated earlier in the decade, given freedom to take risk with depositor money. They gamble, they lose. The bill comes to roughly $160 billion. Taxpayers pay it. Reagan leaves office in January 1989. The economy is growing. The market is higher. Unemployment is lower. His approval rating stands at 63%. He is widely admired. They call it the Reagan Revolution. But look at what changed. The top tax rate fell from 70% to 28%. The national debt tripled. Union membership was cut in half. Financial deregulation produced recurring boom and bust cycles. Manufacturing employment entered a decline that would last for decades. Income inequality began widening in ways not seen since before the Great Depression. Wages stopped tracking productivity. From 1948 to 1973, productivity rose 97%. Wages rose 91%. Workers shared in the gains they created. After Reagan, productivity kept rising. Wages did not. The gap between what workers produced and what they earned widened. That gap became profit, captured by shareholders and executives. The economic model changed. Before Reagan, the system ran on high wages, strong unions, regulated markets, and progressive taxation. After Reagan, it ran on low taxes, weak unions, deregulated finance, and debt-fueled growth. The relationship between labor and capital shifted. Government retreated from wage setting and market discipline. Finance stopped serving the economy and began driving it. Debt normalized. Deficits became permanent. Asset prices mattered more than wages. Ronald Reagan entered office promising to shrink government and balance the budget. He left having expanded the state and tripled the debt. The contradiction didn't matter. The market was up. Unemployment was down. Optimism was high. The long-term consequences took longer to surface. The debt kept compounding. The unions that had looked obsolete turned out to have been the main force pushing wages upward. The deregulation that fueled growth also fueled instability. The wealth that concentrated at the top stayed there. Reagan's core belief was simple. Government doesn't create prosperity. The market does. The role of the state is to step aside, lower taxes, remove constraints, and let capitalism work. What happened in practice was more complicated. Government didn't shrink. It changed what it did. Less redistribution, less regulation, but massive defense spending, massive deficit spending. The state retreated from some areas and expanded deeply into others. The stock market boom made asset owners wealthier, but ownership was increasingly concentrated. In 1980, the top 10% held 67% of all wealth. By 1989, they held 73%. Growth rewarded those who already had assets. At the same time, the safety net weakened. Mental health institutions closed without replacement services. Public housing funding fell. Programs for the poor were cut or eliminated. The assumption was that private charity and personal responsibility would fill the gap. They didn't. The problems grew. Fewer people received help. Ronald Reagan told a story about America: individual success, free markets, limited government, unlimited opportunity. Millions believed it. Many still do. The question isn't whether the story was appealing. It's what the story left out. The workers who lost their unions, and then their jobs. The communities that lost their factories. The taxpayers who would inherit the debt. The financial system that would require repeated rescues. The widening gap between those who won and those who didn't. Reagan was called the Great Communicator. The title fits. He communicated optimism. What he implemented was a restructuring of power, wealth, and economic priorities. One system was replaced with another. The economy he inherited in 1980 was not the economy he left behind in 1989. And the transformation continued long after he was gone. The man who sold the world, or simply a different version of America, one where capital mattered more than labor, where short-term growth mattered more than long-term stability, where markets were trusted to solve problems governments had managed for half a century. He sold a different America. The consequences are still today's reality.